that things have, God willingly, settled down, how do you see bank underwriters reacting to what's in front of them?
I mean, we kind of kept the line. I mean, once COVID obviously began to impact, I think, a lot of banks just didn't know what to do, right? They didn't know what was going to happen. So we tightened up initially, and then, what we call overlays, add additional risk measures to the underwriting. But
what do you mean by that? Like personal guarantees?
No, just typically, debt to income ratio overlays, credit score overlays. Credit scores might have needed a 20-point bump. But we, after we saw that COVID was just going to be something that needed to be managed at the time, that eventually we get to the end of this, we removed them, and actually we've gotten more aggressive with being much more flexible in our guidelines right now.
So interestingly enough, we brought up free money, right? All these programs, not loan programs, whether PPP loan, idle loan. I mean, just yesterday, New York City announced they earmarked $150 million worth of funds and grants for business owners. How much of the money that people are showing on paper is from their job, from their net worth, or how much of it is puffery vis-a-vis this free money? Again, it's a rhetorical question. It's on a case-by-case basis, but that has to be something that goes into underwriting, right? If you are underwriting an owner of a business and you saw that he or she got $150,000 in an idle loan, that's another loan facility that they need to pay back.
Yeah.
So how do you take those into account?
I mean, we definitely want to see a profit and loss. I mean, we're looking at bank statements obviously a lot more diligently, making sure that deposits are made consistently. The profit and loss is basically just a profit and loss. But ultimately, the bank statements tell the story, and shows us the business is still operating.
I have seen banks be a little more flexible with people that were on unemployment. And
we will take.
I mean, before COVID, wasn't it true that if you were on unemployment, that was really a red flag? Now it's like people on 2020 on unemployment can now borrow right now in 2021.
Yeah, we will want to see a pay stub, and obviously, make sure that they're back and the job is stable.
And this goes back to what we were discussing before we started filming. Banks either having or not having the ability to be nimble and to change based on what's going on in the world. That's a really good example right there. So we discussed secondary markets being super hot right now. But what about Queens? Is it still a seller's market?
It is a seller's market, but it is a mixed picture. Year over year in 2020, the prices went up 5.5% in Queens. So that's a pretty substantial number.
What do you attribute that to?
I mean, I think you have to look at the part of the market that's pulling the rest of it up. And it's really that one-family home, or it's the two-family people can use as a one-family. So a home like that is flying off the shelves. If you look at the condo market, is flat or in decline in most parts of Queens. It's only slightly, but it is a little soft. And you have to also consider the multifamilies. I mean, multifamilies, people aren't as interested in them as they once were, unless they're going to occupy them themselves.
So pre-COVID, the oversaturation was 6 to 9 months.
In Long Island City.
Wow.
I mean, of course, every market's different, I guess.
Of course, but with respect to LIC, in that 6 to 9 months, right, you have COVID, it further compounds the existing issue, and now that 6 to 9 might be 9 to 12 or whatever, maybe I'm just spitballing here, but the domino effect for these developers is it's not just the property sitting there, it's what about all your loan agreements, your financing. You have to go back, I can't tell you how many developers we've represented in renegotiations with the underlying lenders, right? The way you underwrote this deal, the construction financing and the fee acquisition financing 3 years ago, it's an entirely different market now.
Right.
You see cranes that are there, that they've stopped moving.
It's just sitting. Yeah,
Exactly.
the time frame is totally
The price of lumber has gone up.
Yeah.
I think it also is, it's partly the reason why I think homes that are not in great shape are just not moving, because the price of construction has gone up so much. People do not want to deal with the apartment buildings in New York City, which has become really challenging. So that's because they basically was no one in that building in Queens for a very long time.
Yeah.
They were working remotely. So there's that. I mean, the cost of new construction is crazy, and people don't want to be bothered. This person who's buying during COVID, they want a place to move in now. They have a need, and that's why they're moving, and they want a place they can move into. If it means they're going to have to renovate the whole place, it's much less desirable, which is another opportunity for a buyer if you're someone that's open to doing that type of work. That's a place where prices are still reasonable, homes that need work.
Yeah, and I mean, and again, opportunity for a buyer, it just brought something to mind. It's a little bit off of what we were talking, but there are loan products that help a buyer get in there, purchase the home, roll in the construction costs, and make one monthly payment.
Yep.
So, I mean, you know, it's a little scary. Yeah, it's scary, but you know, the lender doesn't necessarily partner up with you, but they do have a person that guides you in the process in the construction costs and checks in with you. And it's it is a great opportunity, and the money's not that expensive. It's still, you know, threes, which is, you know, which is good.
Yeah.
And yeah, Bianca. So that's a good point that you mentioned. And then after that home is done, you have a ton of equity versus buying something that's finished, and you know, you might have overpaid, and you know, you got to wait a little while for that money to come back.
I mean, people always ask me, like, what are the opportunities? And I think that when you go back to the seller and thinking about leaving that money on the table, and from the flip side, from the seller's standpoint, I speak with sellers all the time and say, I didn't even want to do anything, I just want to move, I don't want to be done with this. Do the fresh coat of paint, do the little touch-ups, declutter, get the house cleaned up, clean the windows, make the house look great, because that's actually going to be money in your pocket, even though people don't want to be bothered with it. On the flip side, the buyer can take advantage of the sellers that don't want to do it and partner with the lender, which is an awesome opportunity.
And I think in the lending space, things have, specifically in the residential lending market, that things have become so hyper competitive where you need to offer these types of programs like that, rolling in construction costs or adding a borrower just to the note as opposed to the deed and to the mortgage, right? Lenders really need to think outside the box because there's a lot of competition and things are difficult right now for first-time home buyers in New York City.
Yeah, extremely challenging. Bianca and I were talking about it a little while ago. I mean, one thing that we're doing to help, you know, outstanding real estate agents like Bianca is that we will actually submit your loan to underwriting. So you're not just getting a pre-approval, right?
There's some actual teeth behind it.
Yeah, you're getting a commitment, right? And basically your loan is approved through underwriting, subject to just an appraisal and title. And
then on the legal side, we can account for any deficiencies in the appraisal and the contract, title. Money can be earmarked for remediations and whatnot. So that's really interesting.
Yeah.
That really expedites closing.
I mean, it's a huge leg up.
I
was going to say that unfortunately, I think sometimes buyers aren't as educated as they could be about the document that they're provided when they make an offer. And it's really important for them to understand what that document is and what it means and how to really sell themselves to the seller. Because if you're in a competitive bidding situation, being able to offer something like that is going to give you a leg up. But if you just give it to someone and don't explain what it is, you might not be able to leverage it as much as you could. So.
I mean, Bianca, if you're a listing agent, right, you have a ton of listings, you have 20 offers, right, none of them are cash, they all require financing, 19 have pre-approvals. One has a commitment. Which one are you going to consider?
It's a commitment. I mean,
of course.
I mean, that's the thing. It's really understanding all of that and making sure you're positioning your client well. So that's our job on the buy side, working with the lender to make sure that we know exactly what we have in terms of what works best for our buyer. Can we adjust contingencies, right? I mean, we're seeing a lot of offers where people are removing financing contingencies in some cases, removing
Which always makes me nervous.
Yes, I know, as a lawyer.
I mean, will you allow them to remove the financing contingency if they have a commitment already?
I mean, is it called a commitment?
It's a commitment. It's an underwritten commitment letter. Yeah, legitimately, underwriters saw it
on a case-by-case basis. Yeah. But you know, just as a rule of thumb, we attorneys, transactional attorneys, they're a little bit nervous when we limit our clients out and their right to receive back their deposit. So yeah, that's my answer.
So we always say talk to the buyer's attorney. Talk to the buyer's attorney before you present this offer.
Yes, exactly.